Let me ask you something. If the bank disappears tomorrow, who would finance your life? Because whether you realize it or not, you're going to finance cars, finance emergencies, finance opportunities, finance your lifestyle for the rest of your life. The only question is, will you finance it from a bank or from yourself? Today, we're going to talk about why you should even take a meeting with me to learn about becoming your own banker, what actually happens in that meeting, and the biggest hesitations people have before starting a properly structured IBC whole life policy. And yes, I'm going to answer the hard questions. Welcome back to Banking for Legacy podcast. This is Nelson Pizarro. On this podcast, we break down money in a way that's simple, practical, and real. No hype, no fluff, just education so you can think differently about control, debt, and long term wealth. Today, we're diving into why even have meetings about infinite banking, what you actually learn in that first conversation, the biggest fears people have, and the debt trap that keeps most families stuck. Now, before we go further, if you truly want to understand this concept, go read Becoming Your Own Banker book. That book is a foundation. This podcast gives you clarity, the book gives you conviction, and all right, let's get this thing going. People will say, Nelson, why should I even take this meeting? I'm not even going to say yes to you. Good. You shouldn't say yes to anything without understanding it. You don't take the meeting to become an expert. You take the meeting to understand the problem. It's like going to the doctor. You don't walk in expecting to perform surgery. You walk in to figure out what's going on. And money is like the blood flow of your life. If something's leaking, we need to identify where. That's what the meeting does. It builds a foundation. Then comes the biggest hesitations. I heard you never get your money back from the life insurance policies. Let's slow that down. When you put money into a savings account, is it gone? No. When you put money into a 401k, is it gone? No. It is restricted and controlled by someone else, and also will get taxed down the road, but it's not gone. With properly structured whole life designed for IBC, your money builds cash value that grows every single year. It's being repositioned. Think of it like moving money from your checking account into a private vault that you control. And that vault keeps growing no matter what the market is doing. Then I hear this. My family says it's the worst investment. Number one, and this is super important, it is not an investment. Investments go up, and of course, they can go down. The stocks can move, cryptos can crash, real estates have their cycles. Whole life insurance, properly structured, grows every single year. It has done it through wars, through pandemics, and recessions. It doesn't compete with investments. It protects capital. You don't build your house on sand. You build it on concrete. And the policies are the concrete. Now, if you want to go deploy it after you start building these policies to invest, that's the recommendation. But we first have to start a policy, which is the hardest part in most of our minds. Now we get the debt conversation. Then we get into the real pain. I have $50,000 in debt at 20 to 30% interest. Every time I pay it, it feels like it doesn't move. And I know you guys hear the feeling I'm talking about. That's financial quicksand. You step and then you just sink. Here's what I usually say. I guarantee that you have some money elsewhere. And where's that elsewhere? It is in a Roth IRA, a 401k, a saving account, or you're just stuffing cash underneath your mattress. Why wouldn't we reposition money and start building your own financial system? Instead of putting it in there, you just start putting it into policy. Now, side note, There's more strategy involved. We're not moving money blindly. This is just an example for education. But stay with me. Here's another pushback that I get. Well, if I move that into the policy, I still owe it. I still have to pay it back, and I have to pay my policy. Fair. That's understandable. But here's the shift. You're going to finance things for the rest of your life. Cars, appliances, emergencies, vacations, opportunities, investments. So why not finance it from yourself? And here's what would happen when you physically moved some of that savings into a policy, then borrow from it and pay off that big debt. Number one, you will save a lot of money on interest. You can structure it to pay it off faster if you want to. Number three, you can pause payments during tough seasons. Try asking Visa for that flexibility. Number four, when we pay back, I do in quotations, pay back the policy, we're really replenishing our pool of capital so we can use it again. It's more like a deposit back into our policy. And number five, if something happens to you, the loan is wiped out and your beneficiaries receive the remaining death benefit tax-free, which will never happen when you had that money locked away in the loan. That changes the conversation. And I get it. The real fear after this education piece, after this meeting, all these thoughts start happening. You start talking to more and more people, you start doing research, and then you get frustrated and you have no clue what to do. Well, all I ask for any single person that has conversations with IBC practitioners, just start a policy where you're at. Don't look at down the road, just start the policy what you can with. Because usually when you say you're going to do it, you'll never do it. And here's what I've noticed. After people understand it, after the math makes sense, they still hesitate. They worry about making a mistake, which is understandable. They doubt themselves. They ask, if this works, why doesn't everyone do it? And I get it. For decades, we have been taught life insurance is expensive or an expense. You can't borrow from policies. Just dump your money into government programs. Set it and forget it. But most retirement systems we're told to trust started in the 70s/80s. Before that, families were their own banks. They were trusting whole life policies. The very, very wealthy, even banks buy whole life policies. Why do you think? Today, the system separates you from that hard working capital that you created. So when you need money, you have to ask for it. And when you ask, there's going to be a big interest behind that. And usually they're going to say it's only 2, 3, 4, 5%, 20%. But in reality, they're going to get that money before you even pay the principal. So instead of doing all that, why not pay yourself first? I got people asking me, why am I doing these podcasts so short? I just tell them it's real simple. I keep these podcasts short and direct because most people don't want a 3-hour financial lecture. They just need the spark, the shift, the awareness that there's another way. Most people would rather hand their money to someone else, hope it grows, and pray that 30, 40 years from now, there's enough to retire. But hope is not a strategy. Control is. So if something in this episode made you pause and think, if one sentence hit you, if you're tired of feeling like your money works harder for the bank than it does for you, just reach out to me. 619-997-5141. When you call, you get me. There's no sales team, there's no funnel. It's me. I'll answer your calls. I'll answer your questions. I'll give you clarity, and we'll see if it makes sense for your situation. This is Nelson Pizarro with Banking for Legacy Podcast. And remember, your money, your bank, your legacy. Until next time.